Hey everyone, welcome to the video. My name is Jason Newcomer,
And I'm Eric Sheeran.
and we're the advisors of Dogwood Wealth Management, coming to you today to do a video for the second quarter stock market and economic update. So, Eric, walk us through what happened in the major stock market indices for the second quarter.
Yeah, actually a really great time for the S&P 500. The S&P 500 for the quarter was up 4.13%. The Dow was off slightly, just down a little bit over 1%. The NASDAQ was the big winner, up 8.15%.
All right. Well, good returns for the quarter overall. Despite the Dow being slightly negative for the quarter, where's that put us for the year on those indices?
So absolutely, I'll start with the least to greatest. The Dow for the year is up 3.79%. The S&P for the year is up 14.48%, so 14.5%. And the NASDAQ is the big winner, up over 18% on the year.
I think something to just point out here, because there is a pretty big divergence in performance. When you're looking at the Dow up just less than 4% and the NASDAQ up almost 20%, something to keep in mind is how those indices are made up. So the Dow, 30 companies, and some of those names actually had some pretty rough times really this year. Boeing, for instance, has had its fair share of trouble. Nike, most recently, a Dow component. The S&P 500 may be more reflective of the overall market, although it's getting more and more concentrated at the top. And then the NASDAQ, of course, being a tech-heavy index, that's obviously the best performer, but that's kind of what's been working over the last 2 years.
Absolutely, and to look at the largest companies out there by market cap, it's been kind of, we talked a little bit about this earlier in our prep, but it's been a kind of a three-way horse race, if you will, where Apple, Microsoft, and NVIDIA are all trading places, like who's number one, who's the largest company out there. So that has a lot to do with it too.
Yeah, that's definitely one of the big stories of the quarter was, these companies that are worth, I should say they've got a market cap above $3 trillion, which is crazy to believe that we've got three of them. And they've just kind of been rotating back and forth there for a little bit of who's going to have that number one spot. So definitely one of the bigger stories of the quarter. I think the S&P 500 trading above 5,500 for the first time in the second quarter. That was definitely a milestone because we're not that far removed from when it traded above 5,000 for the first time. So
yeah, we were talking on Monday about wouldn't it be great if we could just see a new market high every day this week, and it wouldn't have to be something major. It would be, hey, I think Monday the S&P finished up by 6 points, was it? Mm-hmm. And perfect. Those are the types of markets I like to see, not huge swings and big days, because generally anytime you see that big swing to the upside, you're going to also see this big swing to the downside.
Yeah, not a lot of volatility at all. That was something that was evident in the first quarter. It's continued through the second quarter. It's just been kind of a slow move to the upside. We had a little bit of a pullback to start the quarter in April. I think it saw the S&P fall somewhere around 5%, mm-hmm. But we'll get into kind of why that was. I think, I should mention before we get too deep into this video that we're recording this in the afternoon of July 10th. So we're 1 day from now. The next CPI report, inflation report, will come out tomorrow morning. So a lot of what we talk about today could look totally different 24 hours from now, but the focus of this video is to just talk about what happened in the second quarter, not necessarily what's happening beyond that.
So we're also 2 days away from my 22nd wedding anniversary. I love you, babe.
Good shout out there.
Thank you.
So I think from a macroeconomic standpoint, in the first quarter, and keep in mind a lot of this data comes out on a lag. So for instance, we mentioned that the CPI data, the inflation data for June, doesn't come out usually until a week or two into July. So we don't have the June number just yet. But we'll talk about the first quarter, January, February, and March. I think the theme there was inflation reaccelerating, and are things moving in the wrong direction for the Fed?
So take a step back real quick, Jay. Explain to maybe somebody that just got this video sent to them what CPI stands for and why we track it.
It's the Consumer Price Index, and it's measuring a basket of goods. So they're measuring the same basket of goods and the change in price there. And there's a lot of different subsets of CPI. They'll get into, when you remove food and energy prices, that's called core CPI. There's more recently, they've also removed shelter costs, and they call that super core CPI. And what they're trying to do when they remove things from the basket is say what's outside of the Fed's control. Because arguably you could say energy prices outside of the Fed's control. They could set rates at whatever they want to, but if there's conflict going on in the Middle East or OPEC decides to cut back on production, that's going to impact prices, and the Fed really doesn't have a whole lot of control over that. Same thing with food. We could have a bad season, bad storm, drought, those types of things. Monetary policy really doesn't impact.
We saw some of those geopolitical events earlier this year, and you watched exactly what happened to the energy prices at that point in time.
Right. So first quarter, if the theme was inflation's moving in the wrong direction, I think that's what led to, if you look back at the chart that we had of what happened in the second quarter for the stock market, you'll see that dip in performance at the beginning of April, that 5% pullback that we saw. That coincided right around the time that we got the March inflation data, and I think that was the market saying something's going on here in the economy. Why is inflation reaccelerating? Does the Fed need to raise rates? If you remember, for about a week or two, there was a lot of concern that the Fed's next move might be an interest rate increase, whereas at the beginning of the year we were expecting 6 or 7 rate cuts. So
the market was pricing a lot of that stuff in, and so then you had somewhat of a, call it a market temper tantrum, for lack of a better word. And then around that time, we watched. You quote a lot in your weekly writing about the CME FedWatch tool. And we watched those numbers as to probabilities of rate cuts and how many rate cuts that we're going to have. We started watching those change a little bit.
Yeah, we'll get into more about what the Fed might do for the back half of the year. The other story that I just wanted to mention was, can the market hold together if one of the big stocks fails at the top? There was a lot of concern about that. I think the theme last year for the stock market was really, it's the Magnificent Seven stocks. It's these 7 stocks that are kind of carrying the water for the overall index. And if you remove those 7 companies, what does the performance or the health of the overall market look like? And I think what's interesting is we've seen a few examples where Tesla had certainly fallen. I don't even know if they're considered a magnificent stock anymore at this point. But in 2024, it was a pretty significant drawdown. It's since recovered a lot of that, but it was down, in April more than 40%.
Got down to like 140s or something in there.
Yeah. So it's recovered a lot of that, and I don't think I think it's eclipsed where it was at the beginning of the year. But you also had Nvidia, and that's a company that's obviously done really well. It was in a 20% drawdown in April, and the market really didn't blink an eye. I think later in June we saw Nvidia down 5 or 10%, something like that, and the markets continued to set all-time highs. So,
well, not just that, the earnings on non-Mag 7s have been coming out, and they've been looking really good.
Yeah, we'll get into some earnings things as well later in the video. Let's start with interest rates and kind of where things were. So we'll throw up a chart now of where rates were at the beginning of the year and where they sit today. As you can see, rates have moved up a little bit on things like the 2-year Treasury and the 10-year Treasury. Really not much change longer term, 20-year Treasury and 30. On the shortest end of the curve, right around 3 months, rates might be a little bit lower, but not much change. I think much less of a change than we would have expected at the beginning of the year there. I don't know, Eric, do you have any thoughts on where rates are?
I think with the shift in the shift of the market sentiment as to rate cuts and everything, I think that not just gave the stock market a chance to kind of sell off a little bit and breathe. I think it gave investors a little bit more pause, and the market just kind of started to digest that news. And we've seen that certainly in the rate market and the side of things, especially on the fixed income side.
Yeah, no, I agree. So let's pull up at least the most current probabilities, and you referenced this earlier, the CME Group's FedWatch tool, something that we've obviously kept a close eye on over the last few years. Right now, we're sitting at basically very small chance. I think it's less than a 10% chance of a rate cut when the Fed meets at the end of this month, July. The next meeting that they'll get together to make a policy decision is going to be in September. So just after Labor Day, they'll meet, and currently a little bit better, right around a 75% chance of a cut in September. So I think, again, what's interesting is that has changed. About a month ago, it was only about a 50% chance. So we've had some economic data that suggests the Fed might do something there.
I think Powell's testifying today on that, and so you're seeing a lot of they're in line with he's not surprised, and it's showing that the Fed is doing their job. Maybe the market doesn't like to see that. Obviously, mortgage brokers don't necessarily like to see those types of things, but it's working. You're seeing the economy slow down.
Yeah, so we're definitely, I think, close to seeing a rate cut. If I had to guess, I'd probably say September. I think that one thing that's interesting, and we'll never know, in the real answer to this question, but will the election in November factor into the Fed's policy decisions?
Yeah.
They're supposed to be impartial, apolitical, although they are appointed by the executive branch. September kind of makes sense in that it's far enough away from the election that it doesn't appear that, by doing that, they're intervening or influencing what's going to happen with the election. If they don't move in September, the next opportunity is in November. I think it's like a day or two after the election. So, a chance to kind of give themselves, I guess, a little distance away from the election. That might make the most sense.
Probably.
But, I don't know. I guess we'll never know. Inflation. Let's talk about inflation and the most recent developments. So we mentioned in the first quarter, higher than expected. We kind of saw an acceleration in inflation. That's certainly changed in the second quarter. We're seeing things moving back down in the right direction. We've got, again, we've already mentioned this, but we've got the numbers coming out tomorrow for June. And if we get those, we'll flash that up on the screen. But the Cleveland Fed does have an estimate that they put out. They're expecting core CPI tomorrow to come in right around 3.5. And then 3.6 in July, and so we won't know that number for about another month. But things might be getting back on track, and I think that has certainly added a little bit of a tailwind to what we've seen in the stock market for this quarter.
Absolutely, yeah. It's always so counterintuitive to. You do a really good job of explaining this in a lot of our client meetings, but it sounds that. The amount of unemployment must go up, the amount of people that have to lose their jobs, and how tough things have to get to slow the economy down. It's like, well, that doesn't necessarily make sense, but from a monetary policy standpoint, it seems to be working.
Yeah, they're walking a fine line. The Fed is, and I think that was actually the title of one of the emails that we sent out in the last few weeks. Is the Fed's walking this fine line of trying to bring inflation down and keeping interest rates in a restrictive, area right now at 5.25 to 5.5, without, the labor market falling apart. Now, one thing about the labor market is we do have jobs numbers out for all 3 months in the second quarter. April was a bit of a surprise in how weak it was. But then May and June's numbers came in, I think both were above 200,000 jobs per month. So where we were averaging in the first quarter 256,000 jobs per month, for the second quarter it's 177. 1 month might be an outlier, but we've also seen unemployment rate tick up as well. So I think
from historic lows.
Yeah,
right?
yeah, from historic lows.
Yeah.
3.4, I think, is where it bottomed about a year ago. So we're definitely off of that low. We're at 4.1, which is still, I think, considered full employment. That's still a very low number, but it is something I think to keep an eye on. Is what's going on? Are we seeing cracks in the labor market, and how does that impact when the Fed cuts?
And the data looks promising.
Yeah.
Earnings, average earnings are going down, right?
Yeah.
So,
Yep.
yeah.
So
And as we speak, we're at a 3-year low today, right?
right.
So,
Right. Let's get into a little bit of corporate earnings, because that's how we kind of ended the video the last time, was talking about one question we'll get from clients all the time is, what's your outlook on what's going to happen to the stock market in the second half of the year? And of course, no one knows the answer to that. These things are just impossible to predict, but I think that if we continue to see the economy, broadly speaking, inflation continues to trend down without the labor market falling apart, and the Fed coming in, at the end of this quarter, and we see a rate cut, that's a good economic backdrop. If we continue to see corporate earnings come in as they've been coming in recently, it could be a good sign for the market. Corporate earnings, second quarter, these companies are really good at protecting their bottom line. And I think it's John Butters with FactSet that puts out a lot of good information that we're pretty constantly citing in those weekly emails that we put out, is that 78% of S&P 500 companies beat their earnings per share expectations, which is slightly above the historical average. So that's good to see. Earnings are continuing to grow. Analysts are expecting big things out of these S&P 500 companies. Double-digit growth in 2024, even in 2025, double-digit earnings growth. So I think we'll get that if we've got this good economic backdrop to provide kind of that foundation.
you give a little shot of epinephrine to the market too with a rate cut. Every time that happens, you've heard the old adage, you can't fight the Fed.
Yep.
If they're cutting rates, coming into a strong earnings environment, these are all good things.
They are. I think the risk, though, is if we see a rate cut in September, because we're seeing unemployment kind of get out of control, or because GDP numbers are worse than expected. That's an instance where the Fed could be cutting, but for kind of the wrong reason, so to speak.
With a lot of investors, new investors that haven't seen this higher rate type environment, and just kind of what do they do and how do they navigate through it?
Yeah.
Yep.
So I would say on balance, second quarter, pretty good for the economy, pretty good for the stock market. If the year ended, here, I think anybody would take what the markets have given us for a total year. So we'll see how the second half of the year plays out.
And shameless plug, honestly, for financial planning too, because whatever happens, we were in a meeting the other day and I made a point to a client. You probably know exactly the time that I'm speaking of, but whatever happens, that's why you have a financial plan, right? Markets are going to go up, markets are going to go down. How much risk are you taking? How much risk do you need to take? And having those questions and a good understanding of it, it just puts you in a much better frame of mind to handle what is out there. And if the market's delivering, if the NASDAQ is delivering, 18% for the first half of the year, don't you want that, right?
Right.
So
Yep.
understanding, or a portion of your assets to be increasing by somewhere near there.
Yeah. Well, thank you all for watching this video. Hope you found it informative and educational and helpful, at the very least entertaining.
Have a good day.
Take care.